You say in your notes
Right.
that investment grade credit is the place you want to be versus equity. You'd rather be there because you say it's less exposed than equity at this point. Do you think that we see a point where these geopolitical tensions start to pose more risk perhaps to the equity story than the virus or even to the investment grade credit market? How significant are these geopolitical risks going to become, do you think, ahead of November?
Well, I think the geopolitical risks are meaningful, and it's been interesting because the market knows that the economic hit from the virus is historic, and so is really looking through the very weak earnings that we're seeing from corporates and their very big declines in economic data, rise in unemployment. So it's looking through that, and it's I think in terms of the equity market, and particularly the S&P, is really treating this as a sort of natural disaster, very severe, but is short-lived, and you get a relatively strong recovery and limited permanent economic damage. But one thing which upsets that narrative would be a re-escalation in trade tensions between the world's two largest economies, and I think it's been interesting that the market has actually reacted to that as news more than it has reacted to yet another, tragic though it is, record in terms of U.S. weekly jobless claims. So I think it's something which is a concern for the market, and I think is a potential source of weakness and a correction.
Do you think that market looking through the jobless claims belies a stronger connection between the S&P and the economy? I mean, do you think those two are detached in some senses?
Well, I mean, I think in some respects, if you look at, say, the broader, say, Russell 2000, which is probably a better measure of the sort of investor assessment of the outlook for the real economy in the US, and I think is a more relevant benchmark for those investors in credit, particularly within high yield space. Then we've seen, the Russell meaningfully underperform during the course of this broader rally. So I think part of the story within the US and particularly the S&P 500 has been its composition and the fact that this rally has really been relatively narrow and led by some of those sort of mega cap tech companies. But as I say, I do think that it's an interesting contrast that we have right now, where we have a bond market that is increasingly pricing in negative interest rates being extended to the UK and potentially the US, negative real yields being priced for a long period of time, and yet we're seeing the equity market pricing in, I think, quite a strong second half recovery.